Hi guys, welcome to my channel. My name here is Tolu herself. Okay, so in this video you're going to understand capital allowance in taxation. To understand capital allowance, you must know the definition, types, the qualifying capital expenditure. You must understand the conditions. You must understand carryback capital allowance. You must know the rates and restrictions. You must understand the basis period, and then we solve examples. So we're going to discuss all of these briefly before solving examples. Let's start from definition. What is capital allowance? Capital allowance is simply a relief. It's an allowance, as the name sounds, right? It's a relief given to companies that incur qualifying capital expenditure. Let me explain in a more sensible way. In accounts, you know that when a company buy assets, they are to charge depreciation, okay, because those assets, their value reduce over time, right? When you've been using an asset for like 10 years, the value will be reducing. So as an accountant, you have to charge depreciation. Now, coming to tax, depreciation is a disallowable expenses because the tax authority believes that depreciation has no standard basis, okay? So they give you capital allowance. So capital allowance is a relief granted in lieu of depreciation. So when you're computing company income tax, the taxman would add back depreciation and later deduct capital allowance to relieve the company of the loss in value, right? If you have an asset, probably if a company has an asset, maybe a machine, and then he bought it at 10 million. After 3 years of using the asset, the worth of that machine is no longer 10 million. Okay, but if you're still reporting it as 10 million, it means you are overstating the worth of the business. So that is why there is depreciation, just to capture the fall in value of the business, which comes from the fall in value of the asset. Does that make sense? So let's go to the types. There are different types of capital allowance. We have initial allowance, we have annual allowance, we have balancing. Let me just call this balancing charge, right? Balancing charge. We have investment allowance and we have rural allowance. Okay, so initial allowance is the allowance that is granted in the year that the asset is purchased, and it is only granted once in the lifetime of the asset. When we are solving examples, you understand. Annual allowance is granted annually, right? It's a relief, it's an allowance that is granted annually, and it is always granted on straight line basis. You understand when we're solving examples. Balancing charge is divided into balancing allowance. This is balancing adjustment. Okay, balancing adjustment is divided into balancing allowance and balancing charge. And this balancing adjustment arise when there's a disposal of an asset, right? When you dispose a qualifying capital asset and then there's a loss, that's when you have balancing allowance. When there's a gain, you have balancing charge. So balancing allowance arises when your sales proceed, when the sales proceed is less than the value of the asset, that's the tax written down value. And balancing charge arises when your sales proceed is greater than the tax written down value. Okay, tax written down value is what is the value of the asset in the books at that time. That's what tax written down value is. So when you want to sell, okay, let's say this is the asset now and the value is 5 million, the tax written down value is 5 million. If I want to sell this asset and I sell it at 7 million, it means I've made a gain of 2 million, right? That 2 million is called balancing charge. Balancing charge. So it's called balancing charge because you're going to charge tax. But if I sold it at 4 million instead of 5 million, there's a 1 million loss. It's called balancing allowance. That is, that loss I made should be allowed, right? So that one you deduct. But if it's charged, you add. When we're solving examples, you would understand. Now, investment allowance is a relief. It's usually 10%. It's a relief granted to companies that incur expenses in plant and machinery. If they buy plant and machinery, they give them investment allowance of 10%, right? Then rural allowance is allowance given to companies in rural areas. Maybe there is no electricity, no road, no water, and they need to conduct their business. So when they incur on getting electricity, or when they incur expenses on bad roads, or they incur expenses on water, there are specific rates. I'm going to write those rates now. For facilities, if there are no facilities at all, they give them 100% allowance on the money, on the cost incurred to get the facilities. If they don't have electricity, they give them 50% allowance. If they don't have water, they give them 30% allowance. And if they don't have road, they give them 15% allowance. This rural allowance is very funny to me, but it is what it is. Now let's go to the qualifying capital expenditure. We just discussed the types. So it's not every asset that qualifies as a qualifying capital expenditure. As in, it's not every asset that you can just grant capital allowance in tax. You can just say standing fan. There's a list, right? So I'm going to put the list on the screen as we talk about it. So we have qualifying building expenditure, we have qualifying industrial building expenditure, we have qualifying mining expenditure, we have qualifying plant expenditure, we have qualifying research and development expenditure, qualifying agri expenditure, qualifying public transportation, we have qualifying capital expenditure. This one relates to software. Yeah. So let's move to the conditions. What are the conditions for granting capital allowance? There are three major conditions for granting capital allowance. The first is that the company must have incurred qualifying capital expenditure. Like there must be an evidence that yes, they spent 45 million in buying plants, or they must have incurred qualifying capital expenditure. That's the first condition to be able to grant capital allowance. The second condition is that the claimant must remain the beneficial owner. As in the ownership of assets can be different when it comes to leasing, all these finance lease and operational lease. So the person that owns the asset must be the person that claims that capital allowance, right? At the end of the basis period, the claimant must remain the beneficial owner of that asset. And the third condition is that this qualifying capital expenditure, the assets must be in use wholly, reasonably, exclusively, and necessarily for the purpose of trade or business, right? For purpose of generating the profits that we are taxing. Then let's go to rates and restrictions first. Rates and restrictions. So the rates of capital allowance, I'll put it on the screen. The rates are usually given, okay, in exam questions. You're not expected to cram the rates, although as you solve more questions, you get so used to the rate. Like I know that for building it is 1510. So you're always given the rates, the rate for the initial allowance and the rate for the annual allowance. Okay, so you are always giving capital allowance rate. All you need to do is to check which assets is involved in that question and trace the rates and apply. That's all. Then let's go to the restrictions, right? What is the restriction for capital allowance? If capital allowance for the year is 50 million naira, should you just charge all the capital allowance? I don't know if you guys have watched the video I uploaded on computation of company income tax. You see where capital allowance comes, right? Capital allowance comes just before your total profits. That's the last thing you charge. You understand? You charge from accessible profit. So can you just allow the whole 50 million that you computed as capital allowance for the year? No, it is usually restricted to 66.2/3% of accessible profit. So this is the restriction on capital allowance, okay? Except for manufacturing companies, agro-allied companies, they deal in agricultural products, right? They can charge the whole 50 million, provided their accessible profit can carry it. You can charge everything, okay? So, but for normal companies, maybe the accessible profit is 100 million, and then the capital allowance is showing like 96 million. You can't just charge everything because it is available. You say 66.2. When we are solving examples, you understand 66.2/3%, or just 2/3 of accessible profit, okay? If it is more than that, if it is more than 66/3, it is 66/3 you stick to. It must not go above 66/3% of accessible profit. Okay, so that's the restriction. Then there's also something the Finance Act 2020 amended about small companies that don't have 25 million naira annual turnover should not charge capital allowance. Do you understand? A company that has a turnover of 25 million and below, they are regarded as small companies now by the tax authorities. So those companies, they are not entitled to anything capital allowance until they cross the 25 million threshold. So I've talked about the restrictions that only manufacturing and agro-allied companies can claim 100%. Whatever their capital allowance was calculated to be, they can claim everything. Now let's go to the basis period. Okay, basis period. So you guys know that Finance Act 2020 has already ruled out gap and overlap in basis period and all those complexities that comes with basis period, right? The old provision. So now it also affects capital allowance. Capital allowance, right? The basis period for charging capital allowance is always on preceding year basis. That's the rule. Preceding year basis. So if you buy an asset in 2015, for example, right, the year of assessment where that capital allowance to be charged will be 2016 year of assessment. Does it make sense? When we're solving examples, you're going to understand that. So before we solve examples, let's talk about the carry back capital allowance. It's a situation whereby you have to carry your capital allowance backward. Normally capital allowance is only carried forward, right, to the next year. Maybe you're not able to claim everything because of restrictions, or because there's not even enough accessible profits to charge it on. You can carry it forward, but sometimes you have to carry it back, and you only carry back when there's cessation of business. So if a company ceased operation and they still have some unabsorbed capital allowance or some capital allowance that have not been utilized, you can carry it back. You carry it back against the profits, right, from the penultimate year, no more penultimate year, but from the year before cessation year, the year before this year before cessation year, on and on until you absorb it completely. So when I solve an example also, I'm going to explain that to you guys. This thing is very, very, very simple. Very simple. These are the things you need to understand, which I've already explained. And then I think we should solve examples right now. So let's read this example that is on